Thank you very much and welcome back to the program. Third quarter begins right now. Chuck Malamut is here, and he is our official financial advisor to the Hurley in the Morning program for the past quarter of a century. Chuck leads his team, the Malamut Group, at Morgan Stanley's Northfield office, and this program each week on Tuesday mornings presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this broadcast are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Chuck Malamut, top of the morning to you, my good man.
Good morning, Harry. How are you?
I am very well. Good morning to you.
Unfortunately, as you finished the last hour, you said you don't like to concentrate so much on what happens on a day-to-day basis, but I think we would be a bit remiss if we just sort of glossed over and said it was another day in the books. It's not a big deal, but I do think we should take a minute to kind of reflect as to what happened yesterday, the beginning of a week, which saw, for the most part, action in the Far East, where more of the averages were down than were up, carried over into Europe. The opening was obviously weak, and the market did try to rally somewhat. But as we got to the end of the day, we end up with just I don't want to use the word dismay, because it's that I don't think that's where we are right now, but. You just had a lot of discouragement for a number of different reasons, and ultimately, that minus 300 points, on the Dow.
And it starts, look at the accumulation effect, though, because the 52-week high for the Dow is 18,351. We're now just a tick above 16,000.
Yeah, and I think, Harry, if you take a look at, you can look at from high to low, you can look at I think what's really important is if you take a look at where we are year to date in the S&P 500, roughly down about 6 to 7%, somewhere in that range. But that's certainly what has happened of late, is that the NASDAQ has pretty much rolled over, and particularly, and I know that you've probably commented on it, is some things that have been happening down in Washington, particularly with the biotechnology sector.
Yep.
So if you take a look at yesterday, for instance, there didn't seem to be one clear catalyst to blame for the move, and that's pretty reminiscent of what happened in the prior week. You had some company-specific weaknesses, one of which was that we chatted about just last week as it was unfolding. The scandal regarding, Volkswagen. And then you had one of the world's largest mining companies, basically losing 80% of its market value over the course of the last 6 months. So you had those particular moves. And I think, and again, I'm not going to, as you know, we'll never make a market call here. But typically what happens is, as we saw what happened at the end of August with, everyone throwing the towel in, and then ultimately, the market then staging somewhat of a rebound, oftentimes you test that bottom. And, we are so eerily close to that number right now. I wouldn't be at all surprised, Harry, if we do get back to the number where we were on August the 24th. And that's not necessarily a bad thing, because I think the biggest thing that we think about all day long is this a correction in a multiple-year secular bull market, or is this the beginning, quote, of a bear market?
Do corrections matter whether they're for – sometimes you have a correction and then you hear analysts say – that it's a good thing. Is this the type of correction that could possibly be, I guess you just said it a moment ago, it's not necessarily a bad thing, but when you're down 2,300 points or thereabouts, I think it was 2,300 and some points in the last number of weeks. Is there a silver lining in there somewhere?
Well, Harry, I think there is, because what happens when it's just the most amazing thing that we witness with clients, and it's not just our clients. I think it's all of your listeners go through the same thing. Investors become very, very giddy, and when markets make moves to the upside, and they're willing to overpay to buy a position. And I can't tell you how many times we try to convince investors that maybe you're paying too much for a particular sector or company or just equities in general, and then you have a situation like we're living through right now, where asset prices are down anywhere from 6, 8, 10% year to date, and investors have a tendency to want to sort of climb under a rock or sell their positions. And it's just investor psychology. I mean,
then of course you insure your loss.
Well, not. I mean, if you sell, but what happens is
that was part of what you said.
But
that's why I brought it up.
Investor psychology is such that, I mean, they've written books and volumes on what investors think and why, and you have that ultimate, that herd mentality where everybody tries to get to the same side of the boat at once. You know what happens to the boat, and I think, Harry, that I'm not going to dismiss what's happening in the world, because certainly, economically speaking, things are different now than they were a year ago. But bottom line, if you are selective in your processing and understand what you're buying and why, you have to look at opportunities like this where you are going to dollar cost average at much lower prices. And in a particular case in point, and I'm not going to get political with this, but what happened to the biotechnology sector last week, which rolled over into, again, yesterday.
Well, it shows you a leading candidate. I'm not getting political either. These are just facts. A leading candidate for her party's nomination stomped all over that industry and drove it downward.
Yeah,
no mistaking it.
And I think
I think it's scary she has that she has that power.
Well,
somebody should say she's a kook, and who knows if she's going to have one shred of authority to do any of the kooky things she's talking about.
The industry or the sector, was somewhat overheated to begin with, and it's a momentum-driven play. And then when you get a momentum-driven stock or stocks within a sector, you see what happens. I mean, you get these huge moves. Now, I think what that provides, Harry, is that some of your larger capitalization biotechnology stocks are selling, I think, at really significant price discounts and price-earnings ratios that make them very, very attractive. If you look at what happened with the NASDAQ, and the reason the NASDAQ rolled over compared to the other indices is that you have a lot of the smaller biotechnology names that make up the NASDAQ that got crushed.
Chuck, let me ask you something that I know people think a lot about, because they have to make the decision when a certain investment is going down as to whether they want to cut and run or hang in there, because, my famous expression on the program, when you're here and you're not here, is the only way to ensure your loss is to cash out when you're losing. Now, of course, if you stay in, you could lose more, but if you stay in, you could rally, you could rebound. How do you know when it's time to hold, to fold? What do you say to that?
Well, I think a lot of that, Harry, is based on the dynamics of, one, the sector, and two, the sector, the industry within the sector, and then obviously the company. You see instances where a company gets destroyed for any of a number of reasons, and then you got to sit back and say, okay, have the fundamentals of that particular company changed? Are they losing market share? Are their sales down? Is their price earnings ratio, is it still increasing in spite of a lower stock price? So you have to do a fair amount of homework and due diligence to make that decision, rather than just cut and run, as you just mentioned. Because
Chuck, we literally have today, which I didn't take a look at the pre numbers, but I don't have this feeling like today is going to be just a stupendous day, but I'm not necessarily projecting that it's going to be a horrible day, but I just don't have a warm and fuzzy feeling, with some of maybe the hangover that could be left over from yesterday. So what I'm saying is we have today and tomorrow, and then literally the third quarter is out of here. The month of September is out of here. The month of September has not been very good.
No, but Harry, the month of September has been, unfortunately, and I'm going to say somewhat ugly. And as we, round up the third quarter, then, when clients look at if they're not looking online, they're going to look at their 401k statements to come in the mail. They're not going to be pleasantly pleased. But I think
there was a guide that I read about, I don't know, an hour ago, Chuck, right before we were getting ready for you, somewhere during the 7 o'clock break, I think I read it. And he said that the markets are in, quote, no man's land. I didn't like that. That sounded like Old West. It just didn't sound, I don't know, it didn't sound civilized to me. I will say this, and I know that you don't get into the game of one day at a time and, anything like that, but U.S. stocks are higher right now ahead of confidence in home data. Wall Street is poised to bounce back. That's my market watch that I look at every day, Chuck, in between talking to you, because you're my real market watch. But that's pointing towards a good day.
Well,
I'll
Harry,
take back what I said. But let me ask one question. Real estate, surprisingly, you've always talked about for all these years, Chuck, third rung of the stool. Real estate has been strong.
Real estate has been strong, Harry, and I think that one of the things that we're suffering from here domestically is the fact that what is happening economically, particularly outside of this country, has created this turmoil in our particular markets. Evidence in the fact that we keep going back to China, moving to a more consumer-driven economy. Now, that doesn't happen overnight. So we have to look at, obviously, what's happening with our exports versus our imports. I know that a lot of us are really pleased with what we'll call King Dollar, where the U.S. dollar continues to dominate and is appreciating in value versus other currencies. But the problem with that is, it's great when you travel. The problem with that is that the multinationals in particular that sell, overseas, it's very, very tough to meet your revenue expectations with an increasing dollar. So you're sort of at a catch-22. So the dollar, global liquidity, what's happening in China, global growth. That's where we are with respect to these markets. And the markets, Harry, we've talked about volatility. Volatility is here for some time. You're going to see, moves that, if you're on the side of of looking to buy the market or be long the market and not short the market, volatility can become very, very frustrating. When nobody likes to lose, and when you're down 300 points in the Dow in a given day, investors, there is cause for concern.
Chuck, in terms of how this all started, a lot of this started with China, correct?
It did, Harry. I think the devaluation of their currency on multiple occasions was sort of the beginning of the end, as we'll call it. And you can always blame any of a number of factors, for what has happened in the market. But if you think about it, I think the average investor became very complacent over the last several years because we didn't have, the big violent moves, particularly in a downward direction. And when I was talking with Mike yesterday, he came up with a very good point. He goes, Chuck, it feels like even though we're down 6 or 7% year to date of the S&P, it feels as if, we're down 10, 20, 30%.
Yeah, I agree with Mike. He's a bright man, and that's why he's on your team. Why do you suppose there is that disconnect because I absolutely agree with that statement. If we were taking it more so in a more sobering way, it would be, I think, less hysteria. I don't want to say hysteria, but less concern. But he's right about that analysis when something seems worse than it really is.
And we're going to blame, unfortunately, your friends in the media for a lot of that, because
I agree. Listen, I agree. They're terrible.
If you look at the competing shows, there's one that I really enjoy, which is, I think, provides a lot of intellectual capital. Unfortunately, there's another show that
The Screaming Maniac, that guy
that comes on at 6 p.m., which most clients watch.
Why?
And unfortunately, I think you got to be really concerned, because when you think about what they're trying to accomplish, and that's to keep your eyeball to the next commercial, they do deliver, I think, some important information, which is critical in the investment making decision. But if we weren't surrounded by all that noise, Harry, I'm thinking that we would maybe feel the average investor would feel a little bit better about what's happening.
Because the overheated rhetoric just gets everybody lathered up, gets everybody worked up, and then it makes things worse than it otherwise would be. That's why I think, for example, I am not at all approving of what Volkswagen did. I think it's despicable. I think it's dishonest. But they offered up something like $18 billion, and they're going to get whacked for billions more. Other companies have done the exact same thing, and it cost them like $10 or $17 million. I mean, we're in a different era now. It is so, I guess the media is so on top of anything. And I'm not mitigating what Volkswagen did. I think it's hideous what they did. But the stakes have never been higher.
Well, Harry, you're right. A perfect example is, if you remember, several months ago, all eyes were on Greece.
Yes,
which
I thought was disproportionate to reality, and I've always said that.
And I think what we really should have focused on was the demise of Puerto Rico.
Yes,
because that is more.
I brought up to you. I said, why is Greece so important, but Puerto Rico is not even a whimper? They can't explain it.
Well, it's because what they wanted it's what they wanted to focus on.
Correct.
So I think so. Here's what we got to think about for a second. As you mentioned a few minutes ago, the futures are up today. We got a lot of work to do to make up for where we were yesterday.
And by the way, if you're just joining us, it looks like really good news coming about real estate in just an hour or so. So it looks like it's going to be a pretty good day.
Well, you never want. I'm never going to make a prediction.
I know.
on a day-to-day basis, because the markets, as you know, have a tendency to move very, very quickly. But I being the Nostradamus of the airwaves, I'm not. Right, well, I haven't heard your. I must be missing your daily market call, so maybe you can call me as you are ready to make your prediction. Okay,
Nostradamus.
Really what's important here, Harry, I think for your listeners to understand, is that the bottoming process, as we know it, it's pretty much underway. And while we're not going to be able to time the actual bottom, we think markets appear to be following that traditional bull market correction playbook, Harry, and that's where markets retest the original lows before they ultimately break higher to resume the bull trend. So if you take a look at what happened yesterday with the S&P 500, we're virtually within 1% of the closing low that we hit in August. While we mentioned before that we think the volatility is still going to be out there in upcoming days and weeks, we think that some relief is ultimately in sight, and the markets could calm. And what did we talk about last week? What are we really looking forward to? It's not the Fed meeting in December, because we all know it's going to happen. Earnings are going to come. And, Alcoa starts first week of October for third quarter, and then, fast and furious, through the month. So if we get a break with earnings, chances are as we get into the fourth quarter, and I've seen, some competing firms, even while they've lowered their expectations, they're still looking at the S&P to be around 2,000 before year end. So if we're able to make that move, then investors, I think, for the most part, while they're not going to be giddy and happy, they're going to be, I think, in a better position and feel better at the end of the year than they do currently.
Do you think because people have been through, I'll call it economic turmoil, they've obviously a great recession in 2008 into 2009 and this wacky, unprecedented recovery of the past 6.5, 7 years, do you think people are becoming a little more, I don't know, do they have more of a stomach for volatility than we used to have, or no?
No, Harry, what has actually happened over the last several years is that the retail investor has basically left the equity markets for the most part. I mean, you think about years ago, all those online trading operations that popped up, a lot of them have either closed or merged. So the average investor, as we know it, has become very disappointed with the equity markets, and it did not come back after, the 2008, 2009 Great Recession. So, and they're still sitting on the sidelines with a lot of cash, and I think
it's a lack of trust, correct? Confidence. Lack of confidence.
I think confidence is really the word, because you see what comes out on a day-to-day basis. And as again, we're not going to talk politics, but I just looked at what one of the TV shows did to a fellow that owned casinos here in Atlantic City with an interview on Sunday night, and I thought it was disgraceful.
It was hideous.
The way it was handled. So, but that candidate, I think, did a pretty good job in answering the questions. There were certainly no softballs that were thrown at him.
Not even close. We're going to take a brief time out. Coming back with Chuck Malamut, our official financial advisor to the Early in the Morning program, in just a couple of minutes. For all of your financial planning needs, turn to Chuck and his team, the Malamut Group at Morgan Stanley's Northfield office, 609-383-2010. And one sit down with Chuck, and you will see how he has perfected his concept of total asset management coupled with the all-important asset allocation. And tell Chuck, if you heard about him through me, that we sent you to Chuck Malamut and the Malamut Group. Again, 609-383-2010. We're also brought to you by Dr. Alan Chenman. I was just with him a couple of days ago. He sends his best regards. Had a great visit with Dr. Chenman right before Dr. Chenman. I had my once every 6 months with Lisa, who does the most sophisticated, attention to detail-oriented teeth cleaning that you will ever experience. I mean, she literally does amazing work, and she even does a full oral screening to make sure you have no cancer or anything like that. If she sees something that looks odd, she's not a doctor, but she will tell you, I see something that I don't like, and then she'll refer you to your specialist, to your doctor. Cosmetic and restorative dentist, Dr. Alan Chenman, Dr. Henry Salama, who incidentally is just a magnificent dentist in the field of implant dentistry. It's incredible what he does. He has done groundbreaking techniques, and that he is part of Dr. Chenman's practice is absolutely amazing. He has written about, he speaks, lectures all over the place, travels all the time. He's in all the periodicals. He has done dental implant procedures that save time, things that used to have to be done in multiple appointments. He can do in one appointment, really groundbreaking stuff. They do it all at Dr. Chenman's practice: porcelain veneers, crowns, bridges, inlays, onlays, all the so-called cosmetic and general dentistry aspects that you would expect, the so-called permanent cosmetic dental problems. Dr. Chenman can literally redesign your smile. Go to SmileCenterNJ.com, click on the Smile Gallery, and you'll see photos of actual before and after cases. Call Shannon, because the first step towards a beautiful, healthy smile is to schedule your appointment just like I did. Dial 609-601-2199. Shannon is Dr. Chenman's scheduling coordinator. She does a great job. Schedule your appointment, and you'll experience what I'm talking about in terms of the general and cosmetic dentistry. They can literally give you a smile that you'll be happy to show off. Modern cosmetic dentistry via Dr. Chenman and his dentistry techniques makes it easier than ever for you to have a bright, even smile. Smile Center of Linwood, Dr. Alan Chenman, 1999, New Road, Suite D. It's right before, well, I guess it depends where you're coming from, but if you were coming from Northfield into Linwood, it's right before Summers Point, 1999, New Road. Coming from Northfield, he's on the right-hand side, beautiful modern office, 1999, New Road, Suite D in Linwood, 609-601-2199. Back with Chuck in 2 minutes. We're back, 33 minutes past the hour. Chuck Malamut for all of your financial planning needs. His group, the Malamut team, at Morgan Stanley's Northfield office, available in the full realm of financial services, everything from retirement planning, college building, vacation planning, anything that has to do with your financial well-being. Turn to Chuck. You'll be very, very pleased. Tell him I sent you. Dial 609-383-2010, 609-383-2010. So, Chuck, I know that we have a lot of topics we want to cover. We talked about the market update. We haven't mentioned anything about the Fed.
Yeah, so Janet, your girlfriend, Janet Yellen.
By the way, did she have a health scare?
We
talk about one of the most unreported things ever.
It wasn't. I don't want to call it a health scare. I think what happened was as she was concluding her speech, she became very dehydrated, and as a result needed some some assistance off the stage and a little bit of medical assistance. But
so she just got hydrated and she was fine.
She was back at it. So when she spoke, her comments, the market obviously liked what they heard because it increased the odds that the Fed is going to go make that move later this year. That's basically what she said.
She said it.
It was.
Didn't she almost have to say it because they really have been stepping on sort of their own tail?
Well, her statements, I think, helped solidify the fact that it was certainly a lot more evident in that speech than the statement that went with the September meeting that they had, and that's where the market got very, very confused. So.
I think it's interesting. Never in my lifetime has there been almost joy for raising the interest rates. It's almost like bizarro world.
No, so
yay, we're going to raise interest rates. Yay!
Well, we do.
Yay!
We do need to raise rates, Harry, because you have I know you're going to dispute this fact, but the labor market,
it's fantastic.
The labor market has improved.
100%.
The economy has gotten better. So there are reasons.
Yeah, go ask the American people that.
To justify a rate increase. I'm not going to dispute what you're saying.
Hey, listen, when you go a decade, basically, this is 9+ years, almost a full decade, at zero or near zero, that cannot last. So I'm reluctantly in the crowd that says this must begin, because they've let it go for too long.
And
wouldn't it have been better before when things were even better than they are now?
But I don't think, Harry, it was the time to do that. I mean, now.
So now's the time when China's going crazy and everything's.
I think now is the time, and what happened was that I think the Fed was ready to make the move. I'm not going to, this is just my opinion, Harry.
Well, I personally feel they're afraid not to do it, and that it really isn't the right time. And if this were even a year ago, these same circumstances wouldn't be changed at all, and they wouldn't be doing it. But we are to the point where I do reluctantly agree we have to do it.
So what's happening is, or what had happened was that the Fed, I think, because of all the turmoil in the markets, particularly coming from outside the U.S., put the Fed on hold. They weren't, they said we're not going to make this move right now. So when you look, as we talked about third quarter, profits here in the U.S. are in all likelihood going to continue to outpace profits outside of the United States. I mean, there are opportunities within Europe that we like, but for the most part, the average profits here of U.S. domestic corporations about two and a half times higher than what you have outside the U.S. So if we can remain somewhat decoupled from the rest of the world, that trend should hopefully continue. And then, so that gives the Fed one of the reasons to go ahead and make that move. So now, as we mentioned, the direction of the markets, as we know them, is certainly uncertain. You have a lot of anxiety right now. We had that sharp pullback in August. It looks like, as I mentioned before the break, that we're going to, if we haven't, we're going to retest that. And you're putting sort of a base in, a bottom as it's referred to. So the next trend in equities is going to obviously depend on economic growth and the earnings that we just talked about, this third quarter, fourth quarter, and into 2016. So because there's some confusion, the markets are doing what you're seeing on a day-to-day basis.
I can't disagree with a single word you just said, Chuck. That's why you're, in my estimation, the best in the business. That is intellectually honest. It's real. It's where we are. Some of it's regrettable because, you say very smart things like you can't time the markets and these different things. I think this is a lousy time to be doing this if we were only basing it on what is now. But when you have such an extended period of, things being, this is abnormal to be. Do you agree with that statement? It's unhealthy to be in a 0 to near zero rate environment for 9 and 10 years. It's not good.
It's been too long, and in the test of time, now as the Fed makes that first move and they make another move, you're going to see how the economy and the markets react. So, Harry, look, we talked about China. U.S. equities as we know them are going to struggle, we think, at least on an interim basis, until we understand what's happening with the Chinese economy and is in fact stabilizing. The Fed begins that process of increasing rates. But, the good news is that we expect both of those to happen. But there's another risk that lies on the horizon. I'm really surprised, Harry. It's 8:39, and you've said nothing about this.
That doesn't mean I wasn't going to. It's on my list, but I'm just trying to, be a good teammate here.
So what happened? No, it's actually not oil.
Oh, what is it?
What happened last week, when the Pope made his visit to Washington, and shortly thereafter, John Boehner makes his decision. He's going to resign. So the possibility,
but it didn't move one market. John.
Well, no. But here's the.
That was crazy to me.
But
you have the third in line in succession to the presidency, and not a single market even burped.
But the concern here, Harry, is the fact that we always talk about now. There's another government shutdown out there, and there is a possibility. So his decision, to resign increases the odds of a standoff over government spending. So the resolution that's currently in place keeps our government funded until December the 11th, when the debt ceiling is going to need to be raised. So that's another issue that could drive the volatility of the market, higher. And and it really hasn't gotten a lot of attention, and I'm really surprised at that.
I don't know how to put this. I'm not surprised because basically what's going to happen, I think the markets have actually looked at it and said that the majority leader, so his lieutenant, is going to take over. And I don't want to say it's Boehner continued or Boehner light, but I don't think the markets really are expecting anything too radical.
Yeah, so what happens is if Harry, if in light of everything that's happening, the markets as we know them, the volatility is going to continue. The markets will be somewhat choppy for some time. But, as you mentioned before about investors and who's in and who's out, eventually we expect investors are going to return to focusing on what's really important, and that's on the fundamentals. And if that is the case, we at Morgan Stanley and other analysts believe, and I believe, that the markets at year end, Harry, will be higher than where they are right now. We have a lot of work to do to get there. So as a result of all this, at the end of the day, I know that we all made predictions as to where we were going to be at the end of 2015, and I think at this point in time, a lot of us would be, I don't want to use the word happy or pleased, or I'll use the word okay, with a market that basically it was a throwaway year and we went nowhere. Because you think about, what we've been through over the last several months.
I want to ask you that again. Are you saying we'd be happy with a push at this point?
I think if we recovered from the lows that we put in, and we have a good fourth quarter, and we're able to build a base going into 2016, I think most of us can accept the fact what happened this year.
And then we have what I've been talking about for several months now, because I saw it coming to an extent as a layperson. The lost year. It's be a lost year.
Look. Certainly, right now, it does look like a year that we're going to go nowhere. But we had a lot of volatility, interest rates. Still, everybody's expecting interest rates to move higher, and that has not happened, Harry. It's been. Rates have been consistent throughout the process. When we hit that low in August, the 10-year went below 2%, and now it's back above it. So I'm not quite certain. I think the market obviously has built in one, if not two, rate increases. And that's what you're seeing happening today, particularly in the fixed income world. I
agree with every word you just said, and I think it will be two. And I think there'll be two rather small increases. I don't think it's going to go that super light version that you didn't predict it or anything, Chuck, but you sort of hinted that, or not even hinted, you just brought up the concept maybe they would do something even less than 25 basis points.
Right, an eighth, 0.125.
But I think we're going to get 25 basis points twice.
Here's the problem that we got to think about, Harry, because I know we're getting close to the end here. The Fed obviously put everything on hold, and now they're talking about December. So the delay in starting, this increase, could create somewhat of a headwind for equities as we know it, since we do have some imbalances now that we have to deal with. A lot of pundits are talking about asset, price bubbles, as evidenced in what we saw in the biotechnology space, and uncertainty. So if that's the case, it could force the Fed into tightening at a faster pace than it ultimately wants to. So, all bets, I think, Harry, right now are on earnings. All bets are on the Fed, and hopefully some of this daily volatility will ultimately subside. I think we have to be patient because, market bottoms and bear markets within a bull market don't happen quickly. It takes some time to work through the process.
Very, very good, Chuck. Anything else you want to share? Well done.
No, Harry, that's about it for today.
Solid. You know what you're doing.
We will talk with you soon.
Look forward to it. Until we meet again, Chuck, you've been listening to Chuck Malamut. He heads up his group at Morgan Stanley's Northfield office. You can reach Chuck for all of your financial planning needs at 609-383-2010. The program you just listened to, presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this program weekly are those of Chuck and do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. We'll be back in just a few minutes. Stay with us. A mini open forum segment, and that's been in rare supply. If you want to jump in, you can do so right now at 609-407-1450. We'll get you on air as soon as we come back. And in the 9 o'clock hour this morning, Dr. Bob Zlotnick in studio, the president and the chief executive officer of Atlantic Prevention Resources.